Good morning. My name is Don Vivrette. Welcome to week 6 of It's Your Estate. We're going to talk about retirement accounts with Michael Simon and go through that in just a minute. But first, Pete, do you want to talk about where we are and what's going on?
Sure.
Website up?
Yeah, we're getting towards the end of the season, and we have talked about wills. We have talked about durable powers of attorney. We have talked about advanced healthcare directive and living trust. And one of the pieces that we're missing so far is retirement planning. And our guest speaker today is Michael Simon, and I'm going to introduce him in just a little bit. But I just wanted to go through quickly as to where you can find his outline if you haven't found it already, and how to get to the articles for today's session. So
we go to workshops?
Yes.
We come down here towards the right and we go to materials?
And that's correct. And
It's Your Estate?
It's Your Estate. And then scroll down. And today is retirement planning, and you see on your screen Zoom. And then if you go to the bottom of that, and you'll see the articles. And so we have some articles on the inherited IRA, a little bit for the Secure Act, the new 10-year rule that Michael will be talking about, and the importance of the beneficiary designation forms. So let's go back to Michael's Ask First.
However, before we do that, as always, I'm going to be host, so I will disappear in a minute and ask questions remotely for us. But if you have questions, please, if you move your mouse on your screen, Q&A will pop up. If that pops up, you can ask any questions you want. I read those and monitor them all the way through. To be candid, if you use chat, it's a lot harder to answer your question. So I really honestly wish that you would use Q&A. I know some of you don't like to, but I will respond to those. So I'm going to disappear and let you guys chat.
Okay. Well, first of all, welcome, Michael. Thank you so much for being here today.
My pleasure.
Yeah, looking forward to your presentation as always. It's excellent. This is the estate planning session. It's Your Estate. Financial and estate literacy is the not-for-profit, and our mission is to provide for you education in the financial, estate, and charitable planning area. So, as we do with all of our guest speakers, presenters, let's go through your Ask First form. You have a master's or other advanced degree. And what is a Juris Doctorate?
Well, that's the degree that attorneys get after you've gone through the university. Then there's 3 years of law school. And at the completion of law school, you get your JD degree.
And how many years have you been an attorney?
I got my license in, well, it's 20 years. So I got my license in 2000.
And in your practice, what area of practice do you specialize in, or do you work in?
Yes, my focus is estate planning, and we really don't do much else than that. We help our clients set up their estate plan, and then also help their trustees and surviving spouses when somebody passes away.
Okay, talk a little bit about your practice and how you charge your clients.
Sure. So for estate planning, our firm charges in 2 different ways. The first is what we call our standard pricing, or a fixed fee pricing. And when we're going to do, let's call it a typical estate plan, what that does is that we provide you with a trust, a will, power of attorney, and a healthcare directive. And we do that at a fixed fee, but we like to pack a lot of what we consider extras into that kind of fixed fee pricing. And what I mean by that is that not only do we the will, the trust, the power of attorney, and healthcare directive, but we also help you with your beneficiary designations, which is going to be an important topic for today. And those are the designations that control retirement accounts and insurance. And we spend a lot of extra time in that area, and that's included in the pricing. We also do a deed for you. We include the notarizations. We also like to spend a lot of time with our clients. We usually spend about an hour and a half or 2 hours with our clients designing our estate plan. And at the conclusion, once the documents are completed, we then instead of just mailing you the documents, we have you come back in and I personally sit with you and oversee the execution of the documents. We want to make sure that they're done correctly and signed properly, so when you need them, we don't have any issues. And yes, that takes a lot more time, but we like to do it this way to make sure we get the best product. So for a flat fee pricing for estate planning for a married couple, it usually runs about $2,900, to $3,200. And that again is an all-inclusive pricing. And for single individuals, about $2,400 to $2,600. So that's the flat fee pricing. The alternative is if we have a complex situation, maybe a very large estate, we're disinheriting a child or doing other things like that, then we do those engagements by the hour because we don't know how long that engagement is going to take. And my hourly rate's $425 an hour.
And then, Michael, do you offer any kind of a free consultation as to, hey, I don't know exactly what I need. Can I come in and chat with you for a little bit and to see, well, what kind of things that you would recommend?
Absolutely. So I'm happy to provide a 30-minute consultation to potential clients to either talk about starting an estate plan or maybe look at their existing plan.
Okay. And let's see. I've asked you about your fees so many times that I think we've covered it. But if the important point is, I think that any attorney that you go to, you need to discuss fees before you engage them. Michael, I know you include the change of property deeds in your standard fee price.
That's correct. So we do a deed for someone's primary residence in the standard estate plan, and that includes preparing the deed, the property tax forms, sending it by courier, notarization, recording fees is all inclusive in the pricing.
Yeah, lots of attorneys use that as a separate price, and they charge anywhere from $300 to $600. So make sure you ask that question as to property deeds. And by the way, you should never do your own property deed. Okay, always make sure you get an attorney to do that. Michael, let's get going. You have an excellent presentation. I love your presentation. And this is an area that very, very few attorneys in Orange County spend any amount of time on. And it has so much of an impact on income taxes. And we'll talk more about that as we get into the program.
Great. Well, thanks, Pete. I'm happy to be here. I've got a great presentation for you, packed with a lot of really important information, and I'm going to say timely, because we've had a lot of significant changes in this area regarding retirement accounts in the last few years with the Secure Act and the CARES Act, and I'm going to bring you up to date on all of that. The PowerPoint that you're seeing on your screen today is also the handout. So if you haven't already,
bring up Michael, you want to bring up your presentation?
I think my screen is shared already.
Not on mine. Don, can you see?
So no, we're still on the Ask First form, Michael. So if you
right.
stop sharing and then reshare. There you go. There you go.
There we go.
Now we're up.
Okay, great. What I was going to say is that if any, as Peter mentioned, if you want to download it, it is available on the website. At the end of the presentation, I've allowed some time to answer your questions. Although you can submit questions throughout the presentation, I have a lot of time at the end to answer any additional questions that haven't been addressed. I'm about to say something that I know no one's ever heard before, but I'll answer those questions, and I'm not going to send any of you a bill. So that's the first time an attorney's ever said that. So listen, what are we going to learn today? We're going to learn about, as I mentioned, the latest rules about retirement accounts, and that includes the Secure Act and the CARES Act. We're also going to talk about how we calculate your required minimum distributions for these retirement accounts. And if you don't know what a required minimum distribution is, then you're at the right presentation, because I'm going to explain it to you today. We're also going to talk about the options there are for choosing beneficiaries for these retirement accounts. And as you'll see, that's going to be a really important topic for this morning. I'm going to talk about whether the stretch is dead or alive. And again, if you don't know if your stretch is dead or alive, then great. I'm going to explain it to you today so you'll understand what that means. And finally, at the end of the presentation, we're going to talk about Roth IRAs, which have their own separate set of rules, and we'll cover those rules separately at the end of the presentation.
Michael, let me stop you for just 1 minute.
Uh-huh.
Just out of curiosity, are you licensed in California or any other states?
I'm only licensed in California.
So you can't do a whole plan for someone living in Arizona?
That is correct. No one outside of California. They must be a California resident for a California attorney.
Thank you.
So what are we talking about today? Well, we're talking about retirement accounts. And when I use that word this morning, what I'm talking about when I say retirement accounts are your IRAs, maybe your SEP IRAs, your traditional IRA, your rollover IRA. I'm talking about 401ks, 403bs, 457 plans, KEOs, and pensions. Those are all retirement accounts. So for simplicity, I'll refer to all of these group as a retirement accounts. When I use that terminology, retirement account, I am not talking about Roth IRAs. As I mentioned, they have a separate set of rules, which we'll cover at the end of the presentation. So why do we care about these retirement accounts? What's the big deal? What are the benefits? Well, the first benefit is that if you have one of these retirement accounts, and again, your 401k, your IRA, etc., that when you make a contribution to these accounts and it's deductible, you get to subtract that money from your income. So for example, if you made $50,000 in income in the year, but you were able to make a $5,000 deductible contribution, for example, to an IRA account, well, the good news is that you don't have to pay tax on that $5,000, and we only have a resulting income of $45,000. So that is an immediate benefit that happens with these retirement accounts. Now, the first new rule I want to talk about is under the Secure Act. And interestingly, the Secure Act remove the limitation for contributing money to IRAs depending on your age. So the old rule used to be you had to be under 70 and a half to make a contribution. That age limitation is now eliminated, but remember, you still have to have earned income. So if you're working past 70 and a half and you want to make a contribution, it is permitted now as long as you have earned income. So what's the other benefit about these retirement accounts? And maybe the more important one is that the second point on my slide here is that the contributions, the money we put into those accounts grows tax deferred, meaning we don't have to pay income tax or capital gains tax on these monies as they grow inside of this account. And this creates this amazing potential compounding effect that we really, really can't get anywhere else or in a taxable account. And the money, obviously, it grows on itself since we don't have to take the income tax and the capital gains tax out. So Pete, I know you might know the answer to this question, but any idea how much money is in these various retirement accounts as of 2021?
Maybe about $1 trillion.
Nope, it's $35 trillion.
35
trillion dollars are in these accounts. That's T with a trillion. So an amazing amount of money is inside these accounts. In fact, that's up about $17 trillion in the last 10 or 11 years. So a very large amount of money is in these retirement accounts. So I guess my question to all of you who are watching is, do you think Uncle Sam wants a piece of this action? And the answer is, of course, all the money inside these accounts is pre-tax dollars. Remember, the contributions that you put in, as well as all the money that's grown, or as the money's grown in there, no tax has been paid. Again, we call that pre-tax dollars. So the IRS, in some ways, has a mortgage on these accounts, and they want to get their share of the taxes even after you've passed away. And that's going to be an important point as we go through the presentation today. And in fact, as you'll see, I have a note here about the Secure Act. We'll be talking more about the Secure Act, and the IRS is actually going to collect money more quickly under the Secure Act from our beneficiaries on these retirement accounts after we pass away.
Michael, you said about Uncle Sam. What about California income taxes? Is this state specific, or is this generally all over the country?
Unfortunately, it's not only Uncle Sam, the federal tax, but every state also wants a piece of this action too. There's again, a lot of money that's in these accounts that needs to be subject to taxation according to the IRS and the state. And that really brings us a good transition to this last point. Is one of the more important points of my on the slide here, is that the money inside these accounts is not tax free. It is only tax deferred. And as we'll see throughout this presentation, the IRS and the state are going to get their share one way or the other with very limited exceptions. Now, Pete, you referenced this, and this is my last point before we get into the substantive material, and that is that this area of retirement account planning, or planning with retirement accounts, is a really important area. And sometimes our clients' retirement accounts are the largest asset they have in their estate, maybe more valuable than their house, but is often missed or overlooked in the estate planning process because people get focused on doing their wills, trusts, powers of attorney, and healthcare directive, and they forget about doing their retirement accounts. And so, I consider it a fifth pillar of a foundational estate plan. Again, the will, trust, power of attorney, healthcare directive, but don't forget to address the retirement accounts and the beneficiary designations in the estate planning process.
Yeah, most attorneys just don't do any kind of separate drafting for the retirement accounts.
Yeah, and as I mentioned, because I think we don't have a whole lot of success in just telling our clients to go fix these retirement accounts with proper beneficiary designations, what we do at our firm is we actually prepare a schedule with the exact way that the designation is supposed to look. And we ask our clients to bring in their forms at the final signing meeting, or perhaps beforehand, so that we can prepare them all and give them to our clients to get them properly recorded.
So because I would just want to emphasize the importance part of the estate planning process. How soon after someone's death can beneficiaries access monies from a will, a trust, or from a retirement plan?
Well, oftentimes the retirement plan is something that becomes first available, and we'll talk about that in some later slides because it's an issue we have to address. But the trusts and the wills can take much longer, but simply with a driver's license and a death certificate, here in Orange County, a death certificate takes 7 to 10 days to get. With those items, the money in these retirement accounts can be accessed to by a named beneficiary.
So 2 to 3 weeks after a death?
10 days.
10 days.
Maybe sooner. All right, well, the first part of my presentation is going to be talking about these retirement accounts and the rules during life. So the first rule I want to talk about regarding these retirement accounts and the rules during life is that if you decide to distribute money or take money out of one of these retirement accounts before the age of 59 and a half, well, in that case, unfortunately, there's a penalty. They call it an early withdrawal penalty. And the penalty is 10% federally and 2.5% California. So that's 12.5% cumulatively. Now, remember that this is just the penalty. No income tax has been paid on these assets, so we still have to pay our regular income tax. So for us in California, for example, let's say we have a 30% federal rate and a 10% California rate, that's 40, plus the additional 12.5% could push us above 50% for an early withdrawal penalty. Now, there were some new rules that one of them not applicable anymore, but the CARES Act allowed last year in 2020 some coronavirus related withdrawals to avoid this 12.5% penalty up to $100,000. But those rules are no longer applicable in 2021, so we can't use them. They were only available last year. There are some additional rules in something called a Consolidated Appropriation Act that allows us to waive some of these penalties, or the IRS to waive these penalties if it's a qualified disaster. The president has to declare it, and so it doesn't really apply to many of us. So unfortunately, starting this year, early withdrawal penalties are normally subject to the 12.5% penalty. Now, after the age of 59 and a half, but before the age of 72, and I'll explain not 70 and a half in a minute, you may, but you are not required to withdraw money from your retirement account. Now, there's no penalties because we are beyond the age of 59 and a half. But again, remember, they're still subject to normal income tax because no tax has been paid on the money inside your retirement accounts. And when you withdraw money from these retirement accounts, you get something called a 1099-R from the IRS, which then requires you to report that additional income on your tax return so you can pay the applicable taxes. Now, starting at age 72, and again, not 70 and a half, is where it starts to get interesting. And what happens at age 72 is that the IRS basically is asking us to start withdrawing money from these accounts. They require it, and they require us to do it each year. Now, for years, the rule had been you must start these required minimum distributions starting at the age of 70 and a half. But part of the new Secure Act moved that age to 72. So we don't need to begin this withdrawal process or required minimum withdrawal process until the year you turn age 72. Now, shorthandedly, we often refer to this as an RMD, again, a required minimum distribution. As you've already learned, there's no penalties because we're beyond the age of 59 and a half. But the distributions, as we talked about, are still income subject to regular income tax, and you get that 1099-R. Now, we're going to talk about the details of required minimum distributions, but my last point on this slide is really the basis of understanding this whole process is that the IRS is simply telling you, you are now age 72. We've let you have a deal long enough. We've let you defer the taxes long enough in these retirement accounts. So it's time to start taking out a little bit of money each year, and we'll tell you how much you need to take out for the simple reason is the IRS and the states want to collect their share of the taxes and stop the deferral.
Michael? If I'm 72, 73, whatever, and I'm still working and I'm still contributing to my 401k or IRA, I don't have to take an RMD?
There are certain exceptions if you're still working, and there are also some special rules depending on if you own a certain amount of the company. But correct, if you're still working and you have a retirement plan, you may not be required to start your distributions.
Thank you.
But I'm working and I'm 72 and I'm required to withdraw from the IRA.
Right, but you're probably not contributing into your retirement account.
Yes, I am.
Oh, well, they'll say, so it's something to think about, but be careful. Thank you.
Okay, more about the required minimum distributions. As we mentioned, with limited exception, and that's what Dawn was pointed out, the RMDs must start in the year you turn age 72. Now, under the CARES Act, the required minimum distribution in 2020, I think many people had heard about this, was not required. They waived the RMD for last year because of the coronavirus pandemic. That rule is expired, and in 2021, we do have to do an RMD. There is no relief for that. Now, normally RMDs or required minimum distributions are need to be withdrawn from your retirement account by December 31st of each year. But there is a special rule we call the first year rule, and you can actually delay your distribution in the first year, the year you turn 72, until April 1st of the following year. Now, watch out here because this is often a tax trap for many clients. Let me give you an example. Let's say you turn 72 in 2021 this year, and there's a required minimum distribution. If you choose to take advantage of this first year rule, you could delay your distribution until sometime before April 1st of 2022. But you still have to do your 2022 distribution. So what ends up happening is you have a 2021 distribution happening in 2022, as well as your 2022 distribution, and you end up with two distributions in the same year. We call that bunching of income. And sometimes when we do that, that can push us into a higher tax bracket, cause higher taxation of Social Security and other issues. So be careful. Most of our clients prefer to separate the distributions and not take advantage of this first year rule. Now, more about the required minimum distributions. You can always take more if you want to, meaning that once we calculate your required minimum distribution, which I'll show you in a second, let's say it was $5,000, but you decide to take out $10,000 that year, there's no problem with that, but you don't get any credit for your required minimum distribution for future years. It's just an additional withdrawal. We have to recalculate every year. Now, just to give you a sense about how serious the IRS is, about you doing these required minimum distributions and doing them properly is that there is a 50% penalty. That is 50% penalty on the amount that you leave in an IRA that was supposed to be withdrawn pursuant to a required minimum distribution.
Michael, I was talking to a financial advisor, and he was saying that most individuals start taking out their required minimum distribution in December. And he was recommending that people start looking at this it's the 29th today, start looking at this in November. And so you can get out of the rush of the December month, because some of the things you're going to be talking about, people have to require to take the distribution. There might be some donations going on, etc. But the other thing is that people do not understand their income tax bracket. So when you say, should you take, is there ever a time that you should take out more money out of your IRA than the minimum?
Yeah, that's a really good point. And there's oftentimes confusion. You don't have to do it in December, right? You can do it anytime you want to during the year. But your point is well taken, and that is that maybe some planning should be considered here. Maybe talking with your CPA to see what your taxes are going to look like for a particular year. And maybe this year you have very little income, and this is a year that it would be better to take money out, more money out of the IRA or retirement account than your required minimum distribution. Oftentimes, CPAs can manage the tax brackets, and it might make sense to take more out in a particular year because it will end up to be at a lower tax bracket than future years.
Yeah.
Now, let's talk about how do we calculate this required minimum distribution. Now, the good news is that most banks and brokerage firms will calculate this RMD for you and send you a letter in the year you turn age 72. Having said that, I think it's important that you be able to know how to do this calculation, and we can do it ourselves very simply, and I'll show you in just a second, using an IRS table. We do have to recalculate this every single year, and that's why we use this RMD table and this calculation. So here is the RMD. As you can see, it's relatively simple. We simply take the prior year December 31st balance. We then go to a table, which I'll show you in a second. It's provided by the IRS, and we get our divisor or life expectancy. And then we divide those two numbers together, and it gets our RMD, or our required minimum distribution. And I think the best way to show you this is an example. So this is part of the uniform table, which we'll talk a little bit more about in a minute. But this table, again, is provided by the IRS. And if we go to the red highlight, age 72, the divisor pursuant to the uniform table is 25.6. If we take that 25.6 and put it into our formula, I'm going to use a hypothetical December 31st balance for last year of $100,000. We divide our divisor, our 25.6, into our $100,000, and the IRS is telling us that we need to withdraw $3,906.25. That's all there is to this calculation. And each year you simply go back to the table, look at your age, get your divisor, and look at your balance for December 31st and recalculate.
How do they come up with that divisor?
Well, that divisor is what the IRS says is your actual life expectancy. And in fact, I've just put up a little bit more of the uniform table. You can see if you make it to age 99, you still have 6.7 more years to live.
I like that.
So this is a part of the larger portion of the uniform table, but I've added a third column, which we call the withdrawal rate percentage. And what it does is it simply calculates that divisor or factor life expectancy into a percentage so that you can get an idea of what the IRS is really asking you to do in the amount of withdrawal from a retirement account. So I'm going to go to age 72. We just talked about, our divisor, as we talked about, is 25.6. That converts to a 3.91% withdrawal percentage. So in essence, the IRS is only asking you to take out 3.91%. If you jump to, for example, age 80, you can see our divisor is 18.1, and the IRS is only asking an 80-year-old person to withdraw 5.35% from their retirement account. That's a pretty generous number. Back in 2002, we had much steeper and higher percentages or rates of withdrawal, but these new numbers are pretty generous, relatively new numbers. And in fact, you can imagine that in a decent portfolio with a nice return, you might make a withdrawal of 5.35% of your retirement account, but still have more money in the account at the end of the year because of the growth in the portfolio.
You know, I love this slide because of the fact that most individuals hate taking their withdrawal out because of the tax issue. But if you're the first person I've ever seen that actually put a percentage on it, and you can kind of see how low that percentage is. Yeah, you still have to pay the tax, but you can feel a little bit better about it because it's such a small amount.
Yes.
Michael, does this table change next year?
Don, I have a slide for that.
Oh, gee, that's nice lead. Thank you.
So as we talked about, this life expectancy divisor is from this uniform table. And this uniform table, of course, is reproduced in my slides here, but is also available in IRS publication 590B, which is available all over the internet. Now, most of us use this uniform table. There are some exceptions in a different table for certain circumstances. The most common circumstance is if you have a spouse that is more than 10 years younger than you, then you do use a different table. Now, as Don was just referencing, to make this area more confusing, the IRS has proposed new tables which will become effective. So the tables that you've just seen are effective for 2021, but starting next year, your required minimum distributions, they have changed the factors. Now, it's minute in the amount or in the numbers, but they are slightly different. And we do have to make a note to make sure that next year you use the right table. And again, I would just go to the updated 590B starting next year, and it will show you the correct table for 2022.
And if memory serves me right, the amounts actually went down because our life expectancy has gone up, as I recall.
Yeah, I have a copy of it and some comparisons, and my recollection is that there are some differences. Most of them are negative, and so it's but we're talking about 0.1%. Now, another handy rule for retirement accounts during life is this rule that allows you, if you have more than one IRA account, to calculate your required minimum distributions from multiple IRA accounts and then take it out of a single account. Now, the IRS specifically permits this, but they only allow it for IRA accounts. So let me give you an example. Let's say you have two IRA accounts. One is filled with stocks or other investments that you don't want to disturb, and you have another IRA account which has cash in it. The IRS permits you to do the calculation and calculate your RMD for each of those accounts separately, then add those two numbers together and take the RMD out of one of the accounts, satisfying the RMD for both accounts. But again, we can't do this with 401ks and other types of accounts. The IRS only permitted this with IRA accounts.
Which leads to the question is that if I have a 401k, I have a 403b and maybe a 457 and an IRA account, I have all those accounts because I have had various different careers over my lifespan, working lifespan. First of all, do I have to take out a minimum distribution?
Correct. So for your other accounts, 403Bs, 401ks and others, they are subject to the required minimum distribution rules.
Oh, they are. And I can't just take it out of the one IRA account for all of them.
That's correct.
Okay, so I'd have to calculate for each one what I need to withdraw for that particular year.
With the exception of IRAs, each one has to be calculated and treated separately.
So if someone has those different kinds of accounts, I'm not sure if I'm jumping the gun, Michael. So you tell me if I am. Should they be my philosophy is keep things simple, stupid. should they be rolling those things over to one IRA account, or as simple as possible?
Yes, so that's a really a good topic, and many people end up with different types of retirement accounts. And the issue becomes, should you consolidate them? And there's not one answer for everyone, but there are two general categories of retirement accounts. One of them is employer-sponsored plans, which are governed by a law called ERISA, federal law. And those are our 401ks and 403bs and the like. And to some extent, those accounts have some higher creditor protection. But at the same time, oftentimes they have limited investment choice and limited flexibility because they are governed by ERISA and through the employer plan. So a lot of clients, if they don't have creditor issues and they're not worried about creditor issues, they like to consolidate them into and roll them over into a single IRA in which you have more flexibility and perhaps a bigger investment world to choose from.
And it's more, it's not employer driven. So some of the things that you're going to be talking about won't be applicable to a 401k or a 403b or 457 plan.
That's right.
Plus,
Okay.
It's kind of nice to, when you get it in the mail, that you get one statement instead of 5 different ones.
But
Yes, Don.
we've also stepped on a couple of other things. So one question is, my mother passed away and gave me her IRA. So I am a inherited beneficiary from that. Am I allowed to combine that with my other IRA for RMD purposes?
So in a minute, we are going to talk about
Keep doing this.
in a minute, we're going to talk about inheriting IRAs and retirement accounts, but the short answer is no, they cannot be combined and they must be calculated separately.
How about a SEP?
A SEP IRA can be treated as one of these IRAs and combined.
Okay, thank you.
So another rule that I want to talk about is another rule during life, which is a qualified charitable distribution rule.
QCD. I love the QCD.
Yes, a QCD. So, and what this says is that if you have an IRA and you gift money directly to a charity, you get to exclude that income on your tax return. And again, this is called the qualified charitable distribution rule. Now, for a number of years, this rule has been in flux because it expired and then it was put back in the law and made retroactive. But to the extent we have permanent tax law, it is now part of the permanent tax code. And I think, as you'll see in a minute, more consideration to this rule should be given under our current tax structure. It provides probably even more benefit than it did before. So let me tell you about how the qualified charitable distribution rule works. And the best way to understand it is that without a qualified charitable distribution rule, the way that it used to work, again, without the rule, is that you would withdraw money from your IRA account. You would then take possession of it and then probably write a check to a charity. And then the hope was that, well, let me first say, then that distribution was recorded on your tax return and included in something called your AGI, or adjusted gross income. And then the hope was that because you gave it to a charity, you would get a corresponding charitable deduction and you would end up even. But unfortunately, that didn't work out for many taxpayers. And most importantly, because many taxpayers don't itemize. Remember, we only get a charitable deduction if we itemize. So in this case, under current tax law, the current tax law provides for a much larger, what we call standard deduction. So many of us don't itemize anymore and we take the standard deduction. And so under these rules, we wouldn't get a charitable deduction, but we would have to keep the income on our tax return. Of course, that's going to be resolved, as you'll see in a minute, under these special rules of the qualified charitable distribution. But even if we did itemize and got the the charitable deduction, there were still other issues because we had to include this money on our tax return. It affected Social Security taxation, increased Medicare premiums, and other issues. So in some respect, to the rescue came the benefits, the qualified charitable distribution rule. And what it says is that if we do use this rule, we get to exclude the income on your tax return. So the issues that we just went over, the failure to get a charitable deduction because we take a standard deduction, and all those other things are all cured by the qualified charitable distribution rule. And interestingly enough, if you do use the qualified charitable distribution rule, the distribution, even though it's going to a charity, satisfies your required minimum distribution. So let's think about that for just a second. Let's say you usually write a $1,000 check to Chapman University to the endowment, and you're going to write that out of your checking account. Why not do it out of your IRA account? You could simply ask for a qualified charitable distribution. The money would go directly to Chapman and would not be included on your income tax return, or I better said, will be excluded on your income tax return as income, and it satisfies or partially satisfies your required minimum distribution. So a really good deal.
Yes, it is. And you know what's amazing to me is the number of brokerage firms who have no clue, the person that you talk to, about the qualified charitable distribution. Because one of the reasons is that it's still fairly new, and there's so many new hires that are in the brokerage firms today. So make sure this is the way to do it. Make sure you ask your broker, and if they don't know how to go about it, make sure they find out. This is the way to do it if you are charitably minded and you have to take a distribution.
Okay. Now, there are a couple of rules to keep in mind for the qualified charitable distribution rules. One is that although you can do as little as you want, you cannot exceed $100,000. You have to be over 70 and a half to do this distribution, and that is not a mistake. They left that age at 70 and a half to use this rule, not 72. Distributions, again, must be made directly to the charity, and talk to your CPA if you are going to continue to make post 70 and a half deductible contributions. There's an interaction with the qualified charitable distribution, and the takeaway is simply talk to your CPA before you take that step.
But I'm going to add one thing, and you're probably going to tell me it's on the next slide, and I'm going to apologize. Distribution must be made directly to the charity. The check must be payable to the charity, but you can take possession of the check, make a photocopy of it, put it in a new envelope, mail it to Chapman with a note that says, I'm giving you this money, because if it comes straight from the brokerage house, they won't know who the heck gave them the money, and you'd like credit for it. Because you took a photocopy, you'll give that to your accountant and say, here it is, because your 1099-R has the full amount of the RMD. They may send you another statement that said, this is what you gave to charity.
Yes, and our clients have had sort of mixed experiences. Sometimes the firm would, as you're pointing out, Don, would allow the check to be made payable to the charity and let the client take possession of it. Other times the institution insists that it had to go directly. But you raise another important point, is that if it does go directly, oftentimes there's no reference to your name. And unless you call the charity perhaps ahead of time to let them know it's on the way, they'll simply get a check from an institution for X amount of dollars and not know where it came from.
Correct.
Now, there is some interesting potential pending legislation. Again, important to point out that this is not the law, and perhaps is changing by the hour as they're arguing in DC at the moment. But there has been some discussion of another act they're calling Secure 2.0. And interesting, they're suggesting possibly moving the required age from 72 to 75. So that would be interesting, something to keep an eye on. The Secure 2.0 also has some interesting exemptions. For example, if you don't have a lot of net worth or a lot of money, there might be just an exemption from doing an RMD altogether, increasing some opportunities to do larger contributions to retirement accounts. And there's also some pending legislation to, I guess I would say, punish some people with very large IRAs. There's some legislation being discussed about a 50% penalty on amounts over $10 million in retirement accounts. And of course, you may have read about the PayPal, one of the founders of PayPal, who used some of the laws to get $5 billion in his Roth IRA. And so there's some legislation that may or may not come to fruition to address the issue and how he got $5 billion in that account.
You know, the interesting thing about the $5 billion Roth is that it really points out how awesome the Roth is. First of all, that somebody can get tax-free income for the rest of their life, and even pass that tax-free income off to their heirs for a while. But it gives you, if you have some dollars that you have in a retirement account, you need to work with your CPA to see how you could take advantage of, not advantage, but use the tax laws as they are written. It's complicated, and you need these professionals. It's worthwhile to pay the professionals to find out how to best go about planning, minimizing your taxes, how to give to charity, how to have title to houses. It's just all about, you need to have these professionals handy, and you need to use them, because look at this, $5 billion Roth. It's amazing.
All right, well, the second part of my presentation is about these retirement accounts, choosing beneficiaries, and the rules for these accounts after death. Now, I know all of you are likely at home. This would be a good time to turn on the espresso machine and have a shot of coffee. The IRS doesn't make it easy in this area to understand the rules. So what I've done is I've come up with 5 concepts that we'll go over. And I think if you understand these 5 concepts, it'll give you a better idea on how these accounts are treated after death and how we pick beneficiaries. So the first concept is that during your lifetime for these retirement accounts, you get to pick a beneficiary or beneficiaries for these accounts by filling out a form we call a beneficiary designation form. Now, the good news, as you'll see under the subpoint, is that if you fill out this form and submit it correctly, that this is a payable on death. We call it a POD or a TOD, and that means it's not probatable. So by filling out these forms properly, you can have your retirement account avoid probate. Now, there used to be some rules about when and how you could change these, but those have all been eliminated, and you can change these beneficiary designations anytime that you want to. And this third subpoint is maybe one of the more important ones, because there's often a misunderstanding in this area. And that is that it is these beneficiary designation forms that control what happens to these accounts, not your will and not your trust. So if you have a beneficiary designation that says I leave the retirement account to my sister, and your trust and will say leave everything to my brother, it is the beneficiary designation that controls and supersedes your other estate planning. And importantly, by doing your will and trust, you have not taken care of your retirement accounts, because we still have to do beneficiary designations. Now, the second concept is that after you've passed away, the designated beneficiary, again, the one that you've appointed on this form, has some ability to defer taxes until the money is withdrawn. And that is important. They don't necessarily have to pay all the tax immediately. And the third concept is the IRS, of course, still wants their share and is going to require the named beneficiary to withdraw money from this account. So again, at some point, the IRS can get its share. And that brings us to, I think it's the fourth concept, and that is from a tax standpoint, it is preferred that your beneficiary avoid taking a lump sum distribution, meaning taking it all in one shot during a year, because not only do they lose the potential for some tax deferred growth, which we'll talk about in a second, but they may pay the highest taxes because all the distribution is going to come out in 1 year. And we'll talk more about that in just a minute. The fifth concept is that generally the strategy is to try to make the beneficiary withdrawal period as long as possible. Now, before Secure, we used to do something we called stretching a retirement account, and we could literally create decades of tax deferred growth, 20, 30, 40 years of tax deferred growth. But unfortunately, because of the Secure Act, it essentially, for most of us, eliminates the stretch, and that, again, the ability to defer the income taxes of retirement accounts for long periods of time. And in essence, the Secure Act pretty much requires the accounts to be distributed within 10 years of the death of the account holder. Now, there are some exceptions. We call them EDBs, or eligible designated beneficiaries. And those people are not subject to the 10-year rule. Those include surviving spouses, children of taxpayers who haven't reached the age of majority, disabled or chronically ill beneficiaries, and also beneficiaries who are not more than 10 years younger. But for the rest of us, we are sort of stuck with this 10-year rule. And with that in mind, and those concepts in mind, it is why that looking at beneficiary designations and choosing beneficiaries is such an important topic. And that's what we're going to look at now, is selecting beneficiaries for these various retirement accounts. Now, I have broken down our options for choosing beneficiaries for these retirement accounts into 5 categories. As you can see, spouses, children, grandchildren, or other adults, possibly trusts, possibly charities, or maybe some combination of all of the other ones. So what I'm going to do is I'm going to go through each of those categories, and we can talk about the advantages and disadvantages of each of those choices. So I'm going to start out with spouses as beneficiaries on our retirement accounts. Again, that's filling out a beneficiary designation form and naming a spouse as a beneficiary. Now, the benefits of doing that is, of course, that the money becomes immediately available to the spouse after you pass away. There is no 10-year limitation under the Secure Act. We don't have to worry about that because our spouse is the beneficiary. But most of us take advantage of a special rule we call a spousal rollover rule. And this, again, is only available to married couples who name spouses as beneficiaries. And I'm going to give you a sort of an illustration of what this looks like. As you can see in the upper left-hand corner, we'll assume that you have an IRA account in my example, and you've named your spouse as the beneficiary. If you pass away, the spouse has the ability to open up a new IRA account, transfer all the assets from your existing IRA account, and then that new IRA account for the spouse becomes his or her IRA account as if it was their account from the beginning. Meaning if they haven't reached the age of 72, well, then there's no required minimum distributions. If they want to pick new beneficiaries, perhaps younger beneficiaries to create further tax-deferred growth, that's possible. And also, when we do it this way, the Supreme Court a few years ago said that there may even be some higher creditor protection when we do a quote-unquote spousal rollover to a new IRA. So a lot of clients who are married do take advantage of this spousal rollover rule. Now, it doesn't fit everybody. There are disadvantages of naming a spouse as a beneficiary. So, for example, a spouse, you may not want to have a spouse having complete control of the money and choosing beneficiaries after you pass away. And maybe this might be an issue with blended family and children from other marriages, where we're having the spouse having unlimited control of the retirement account isn't the objective. Now, the second category of beneficiaries is perhaps picking a child, a grandchild, or other adult as a beneficiary for these retirement accounts. Now, under the Secure Act, as I mentioned, minor children are exempted from the 10-year rule. And the way that it works is that if you have a minor beneficiary, they get to use their life expectancy until they reach the age of majority, and then they get 10 years. Now, the reality here, though, is that this is somewhat theoretical because we, as we'll talk about in a minute, we never want to name a minor beneficiary out as an outright beneficiary. We have to come up with a different solution. And as we'll talk about in a minute, it creates a lot of headaches. So it's not really feasible to name minor beneficiaries as outright beneficiaries. Now, we can name adult children or grandchildren or other individuals. They will be subject to that 10-year rule that I talked about. And having said that, even though they're subject to the 10-year rule, there are potentially many years of tax deferred growth, specifically 10 years. So that's, nothing to sneeze at. That's a decade of tax deferred growth. And as we sort of referenced earlier, perhaps maybe we manage the tax brackets during that 10-year period. And maybe year 2, there's very little income. So we take more out that year. And all your requirement is to empty the account by the 10th year. Now, what are the disadvantages of naming children as outright beneficiaries? Well, as we talked about, we certainly don't want to name minor children or grandchildren, etc. But the second subpoint is that they may do a lump sum distribution, and they may have irresponsible spending, and they may have creditors after them. So we have to factor those things in picking beneficiaries. As we mentioned earlier in the program, this money often becomes the first money available to children. And as I joke, shortly after your passing, always a new car is in the future and a remodeled kitchen.
Yeah. What about naming minor children in somebody's will or in their living trust? Are there also problems there?
Well, certainly in a will or a trust, we can have similar problems. Oftentimes, if you have a good will or a good trust, those issues are addressed where we will either create custodial accounts or sub-trust, we call them, so that the children don't get this money outright at a young age and someone else is appointed to take care of it for them.
When can a child receive money in their own name?
At the age of 18.
So,
But however, I was going to say 18 is the legal age. It may not be the correct age for a child to receive a large sum of money.
okay. So, but at 18, they can sign on behalf of themselves. Before 18, what do you have to go through in order to, if money is left to a child?
So if, for example, and we were going to address this a little bit later, but we'll talk about it now, is that if we name let's say a grandchild or a child as a beneficiary of one of these retirement accounts and they are not at the age of 18, I know that this is the best intentions and people, are just trying to do something nice for a child or a grandchild, but because they have no legal signature, we have to go to court and create something called a guardianship. And it is cumbersome and expensive, but it is the only way that we can take control of these monies that are left to someone under the age of 18. And then the problem is, even if we do all that and have a guardianship, as soon as the child turns 18 or the grandchild, then they have access to the money in an unfettered access, which is also ends up having a bad result.
And that applies to a living trust as well as a retirement plan.
That's right.
Okay.
Now, the third trust, which is a little bit related to what we were just talking about, is that we can name a trust as a beneficiary. We can do that if the trust meets certain criteria. The benefit is, of course, is that it provides this missing control that we were just referencing. It puts somebody else in charge of the money so that the child doesn't have immediate access to the money. We can then obviously protect the assets from the courts and the guardianship, irresponsible spending, potential creditors. And if a trust is done properly under the new Secure Act, we can take advantage of our EDBs, our eligible designated beneficiaries like spouses and disabled children and those kinds of things. So there is a possibility to use a trust as a tool for a beneficiary designation. Now, there are disadvantages to naming a trust. Of course, if we name a trust and we want to do a spousal rollover, it's not available because a trust is not our spouse. The trust must be drafted with proper provisions to qualify under the new Secure Act. So if you have a trust as a beneficiary, and I recommend it being reviewed now that the Secure Act is passed. The other issue is that we don't actually pay higher income taxes, but we pay higher income tax faster in trusts, meaning that we may end up paying more taxes in the end. The reason is that if money from a retirement account stays inside of a trust, at $12,000, it's at the highest income tax rate. The other issues is that this can be very administratively complex. When you walk into Bank of America or Merrill Lynch and say that you're the trustee of a trust that's a beneficiary under an IRA or a retirement account, usually that spins somebody's head.
Yeah, they won't have a clue. You think QCDs are an issue? Try to have a trust as a beneficiary. Oh my gosh.
Now, the other issue is that there's expensive, right? For this to be done properly, normally you may have to create separate trusts for children and grandchildren and things like that. So one of our famous commentators in this area of retirement account planning, her name is Natalie Choate. She's a national speaker, and she simply says, look, this can work, but it has to be compelling. There has to be a compelling reason for us to go down this road. And I agree with that. If it isn't warranted, then we don't want to be in this area.
Just for example, Michael, if somebody wants a trust in this area, what would you charge approximately just for one trust?
Right. It's a couple $1,000s for each trust, $2,000 to $3,000.
Okay. And that's just on the front end. That's not even counting the administrative end.
That's right. Now, all morning long, I've been talking about how the IRS is going to get their share. Well, this is one area, if we name a charity as a beneficiary, that the IRS doesn't get their share. Because remember, charities don't pay income taxes. Also, naming a charity often can reduce estate taxes if we're going to be subject to estate taxes. So this is a really important option here, is using a charity to avoid all of this tax ramifications that we've been talking about. And what we find is that many people, before they see us, are doing just opposite of what they need to do. And what I mean by that is that we find when clients come into us, their trust or their existing estate plan gives their children these retirement assets, and we saddle the children and grandchildren with all the taxes, and they make their charitable gifts out of their trust, which has already been taxed. And we want to reverse that, right? If you're charitably inclined, then use these retirement account assets to satisfy your charitable inclinations, and we end up with a better tax result for you and the children and other beneficiaries.
Yeah, and that brings up the Dawn's presentation on the charitable remainder trust and the charitable gift annuities. You can really do some creative planning using those tools to benefit some beneficiaries and your favorite charity.
That's right. Now, the fifth option for this is remember, these aren't mutually exclusive. So you might have a spouse as a partial beneficiary, a child, a grandchild, or maybe you take a larger IRA in this illustration and break it into smaller IRAs with separate beneficiaries. So there's lots of options here to choose beneficiaries for these retirement accounts. Now, what about responding to the Secure Act? And what I mean by that is that responding to this new issue where in most cases we only have the 10 years to withdraw the money. As we talked about at the beginning, unfortunately, the stretch is dead for most cases, but what could we do about it? Is there anything we could do to mimic the stretch or other things that we could do to remedy the Secure Act? So one possibility is that we simply accept the taxes. It is a 10-year period. There is 10 years worth of deferral, and we manage the tax brackets like I talked about, maybe taking more out in another year where we have lower income and those kind of things to end up with the best result over the 10-year period. Another option might be charitable remainder trusts. There is a possibility that you could create a charitable remainder trust, name that trust as a beneficiary, and potentially mimic the stretch. If you're charitably inclined, this might be an option. Is this one you want to comment on, Pete?
Yeah, it's the charitable remainder trust almost acts like an IRA because anything that goes into it or that is done with inside the charitable remainder trust, there are no tax implications until the money is withdrawn. Unlike if you name a living trust as your IRA beneficiary, that living trust is now a tax-paying entity, and it has severe tax consequences. So, but a charitable remainder trust is an option, but it's not a slam dunk. People need to find out, go to their advisors, talk about it, but remember, please go to an advisor that's familiar with this. I mean, you go to another level when you talk to people about IRAs and charitable remainder trust combined. Not every estate planning attorney or CPA is familiar with this area.
Now, the third point I have on this slide is some clients have contemplated actually buying insurance to replace what they expect to be the additional taxes because of the 10-year limitation in the Secure Act. So that's a possibility. In a few slides from now, we're going to be talking about Roth conversions, but that's an idea too. Maybe we can convert some of our regular retirement accounts into Roth accounts, as you'll see in a little while. That could have a good result also. As we talked about, we could also look at giving some of this money to charity, as we talked about. That certainly solves the problem. And my favorite one is you can just simply spend it. Now,
what a concept, huh?
Yeah. Well, as we've talked about, Pete, I've been doing this 21 years now, and some people's sole purpose in their life was to take the least amount they could out of their retirement accounts and to stretch their retirement accounts for the longest period of time. So it really is a sort of a titanic shift the way that these are now going to be treated.
Yes.
So this is an important slide because it addresses some of the mistakes we've seen for people who've come to us for their estate planning and to try to solve some of their problems. And so here's a list of some mistakes I've seen on beneficiary designations. The first one is not naming a beneficiary. Of course, that's a very popular one. Unfortunately, people do leave these blank, and that's certainly problematic. In most results, if the account is significant enough and the beneficiary designation is blank, well, in that circumstance, then we have to go to probate court. And that's a mess because we're in probate court, but it's a double mess because it's an IRA and probate court or a retirement account and probate court, and it makes a real issue. We get the same result. And again, people doing this with the best intentions, and that's writing in on their beneficiary designation form the words "my estate." And I think people think that perhaps what that means is to find my closest living relative, but unfortunately it doesn't have legal significance, and it pushes us usually back into probate court. It's a tantamount to leaving it blank. So don't write in.
Yeah, we just had a case that somebody named my estate on a IRA a beneficiary form, and the IRA had $300,000 in the IRA. And so that went over the $166,000 that you can have a short kind of form probate. And it happened just recently in a COVID period. So it was 2.5 years before we got through probate. It's just do not, make sure you look at your beneficiary designation forms. Don't use my estate.
The third point, of course, we already covered, is naming beneficiaries. As we talked about, we would have to establish a guardianship through the court, and that would also result in the child or grandchild or minor receiving all of the money when they turn age 18. So again, I know it's the best intentions, but we don't really want to name minors as outright beneficiaries. The next point is not naming both primary and contingent beneficiaries. This is a mistake we see in our practice. When you look at your beneficiary designation form, there is in essence a primary section or a first section for our first beneficiaries, and then a backup section, a secondary section, we call it contingent beneficiaries. And we want to make sure that you fill out both of those sections with thought. And why I say that is that, of course, unfortunately, life doesn't always go as planned. And if that's the case, we want some backup or contingent beneficiaries. But there's also something we can do we call post-mortem estate planning. And what I mean by that is that maybe there's a reason, even if our primary beneficiaries are alive, that the primary beneficiaries don't want, need, or for other reasons want to take their share of the retirement account. If we've done this properly, we might be able to disclaim money and have it go down to our secondary beneficiaries and end up with a better result. But that can't be done unless we've given thought and filled out both primary and contingent sections of our beneficiary form.
Yeah, your point is just right on. And it's also, it just kind of goes with your next 2 points that you're going to be making. But people don't keep copies of their beneficiary designation forms with their estate planning documents. So as they age or take a look at it, they forget as to who they named. And people are living longer. We just had a person who just recently died at 98, and both her primary and her contingent beneficiaries had died before them. And so we're in probate just on the IRA account.
Yeah, that's too bad. Now, that's really dovetails into these next points, is not keeping your beneficiary designations up to date. You gave an example. We often have, single individuals come in and we find out that their spouse from 2 marriages ago are named as their primary beneficiaries on the retirement account. We want to obviously avoid that and keep things up to date.
So who wins? The beneficiary, the retirement plan had my previous wife on there, and now my present wife, who I've lived with for 40 years, Doesn't she get it all?
Well, luckily, there are some laws that try to address this, and if we do have a prior spouse as a beneficiary, not on everything, this law doesn't work for everything, but in the area of IRAs and retirement accounts, would void that designation, even though we had a prior spouse on there.
Okay.
Now, the second to last point is not keeping records of beneficiary designations. And you just mentioned this, Pete, and this is really important because we don't want a he said, she said kind of situation with your institution that holds your retirement account. And there's been a lot of consolidation in the banking and brokerage industry. And what we recommend is that once you file your beneficiary designation, that you get a confirmation letter. And this is usually generated automatically, and we keep it with your important records and other estate planning documents. And if you already have your designation, you can simply call your employer or the bank or the brokerage firm and say, give me a confirmation letter, and they'll mail one to you or email one to you. And the idea here is that you want proof that you have your designation on file, because as I mentioned, if your beneficiaries call up your former employer or your retirement account, IRA account holder, and they say, we don't have one, unless you've got some documentation from that institution proving it, then you're probably going to lose. We just had a situation like that where somebody passed away with a retirement account, and although the successors believed that there was one on file, the retirement account custodian simply said, well, we don't have one. And unfortunately, this wasn't a client of ours. We didn't have any proof to the otherwise. Okay. And the last point here for mistakes is, and we've talked about this, is not considering or planning for the income tax issues when we're selecting beneficiaries, because again, particularly with this new Secure Act, the income tax is something that we really need to pay attention to.
We haven't mentioned this yet, but most people think about death and they think estate taxes. So estate taxes for most of us are not even in the picture, but income taxes on these are. And there's a term called IRD. What does that mean?
That is a term which is called income in respect of a decedent. And what it means is that if there's money that hasn't been taxed and you've passed away, that money needs to be taxed. So IRD examples might be your retirement accounts that haven't been taxed, perhaps annuities and other investments like that. And the untaxed money we call IRD.
So if somebody is working and gets a payroll check or a W-2 and they're deceased, so that money is taxed.
That's right.
And so so IRD, so all of us have some sort of an IRD estate.
Yes.
And we need to keep that as low as possible. And so annuities you mentioned, 401ks, 403bs, 457 plans, all of those are subject to IRD.
That's right.
Okay.
So the last part of my presentation in the time we have left is to talk about Roth IRAs. And as I mentioned earlier in the presentation, the Roth IRAs actually have a separate set of rules.
And they're not subject to IRD, is that correct?
That's right, since this money, as we'll talk about, is tax-free. So what are the benefits of a Roth IRA? Why do we care about these Roth so much? The first reason is that all of the stuff we've been talking about this morning about calculating your RMDs and required minimum distributions, incredibly, Roth IRAs do not have RMDs or required minimum distributions for the owners. So no RMDs for your Roth account. You can make contributions to these Roth accounts as long as you have earned income. There is no age limitation. The third point is the most important point, is that the money inside these accounts is tax-free, including the growth on the money. And I know we've talked about this, Pete, a lot. It's incredible that such this vehicle exists, but it is an amazing opportunity to grow money tax-free. Further, that the distributions to you and your beneficiaries in the future can also be tax-free. And if you pass away, although the beneficiaries can only leave your tax-free Roth account for 10 years. They can still stretch it for 10 years. If we have a spouse, we can do that spousal rollover and they can take over your Roth account as if they owned it. So a lot of really neat benefits. Now, you're probably saying to yourself, well, how do I get one of these Roths? I don't like my old junky retirement account. And there is something we call, a Roth conversion. And what we can do is we can convert a traditional IRA or other retirement account to a Roth by doing what we call a Roth conversion. Now, in prior years, there had been some income tax limitations, and what it used to be $150,000. If you made more than $150,000, you couldn't do a Roth conversion, but they took that limitation away. So everybody is eligible to do a Roth conversion. And the reason is that if you do the Roth conversion, you do have to pay the income tax on what you convert from a regular retirement account into a Roth account. So this can be a lot of money, and a lot of thought needs to be put into it. A lot of careful analysis to see if it really makes sense. One last point before we look at some factors about Roth conversions, and that is that there are no more recharacterizations. And what I mean by that is that prior to 2018, you could actually do a Roth conversion and then wait to the following year until October 15th of the following year and decide whether you like the results. And if you didn't like the results, you could recharacterize it and put it all back as if it never happened. They put a kibosh on that in 2018, so you no longer can recharacterize. And the point is that if you pull the trigger on a Roth, you are stuck with results. We can't change it. Now, what are the factors that we would look at if we are considering a Roth conversion? So the first factor might be that if you expect your tax rate to be higher in retirement in future years, well, then maybe that's a factor worth considering, right? You can do a Roth conversion. Of course, you're going to pay the taxes, but maybe it will be at a lower rate. So that's a factor to consider. You have to think, second point, think that you will not need the money for living expenses, because we don't want to go to all of this, convert it, pay the tax, and then you're simply going to spend it. The third point ties to that is that the same thing is that if we're going to do this conversion and pay the tax, we want to make sure that you have an investment time horizon that's long enough to benefit from this tax-free growth inside of a Roth IRA. Now, the second to last point, and is the most perhaps important point in considering Roth conversions, and that is that you have to be able to pay the taxes on the Roth conversion using what I'm calling separate funds. And what I mean by that is that in an example, if we have a regular IRA, a traditional IRA with $100,000 in it, and we want to convert that that IRA into a Roth, and I'm just going to say, let's say the tax bill is $30,000. We don't want to take the $30,000 out of the traditional IRA and only net $70,000 in our Roth. The numbers don't work very well.
In other words, it's not tax wise.
It's not tax wise, correct?
Yeah.
And remember, we're trying to maximize this tax-free growth. And so when we only have $70,000 in our net in our Roth, we have only versus potentially a full $100,000, then the numbers don't work so well. So what we want to do is when we want to transfer the full amount, in my hypothetical, $100,000 from a traditional account into the Roth, and then the $30,000 tax bill, we use separate funds to pay for it, maybe out of your checking account, out of your trust brokerage account or something like that.
It's the same idea, is that you don't want municipal bonds in your Roth IRA, because Roth IRAs don't pay any tax. So you need to have a little bit of understanding on taxes. You don't want an annuity inside of a Roth IRA. It's just silly. So if you're going to convert or thinking about converting, make sure you talk to an attorney or a financial advisor who understands your tax situation, so that it's a wonderful tool, and you can do it. Is there a limit as to how much you can do on an annual basis, or a minimum as to how much you can do as far as a conversion is concerned?
Yeah, the answer is no to both those questions. And that's really raises a good point, is that, you can do as much as you want, but you can also do as little as you want. And this gets back to managing the tax brackets. And maybe one year you're in a low income tax and it makes sense to do a Roth conversion during that year. And what a CPA can do is also look at the tax brackets and, maybe without changing a tax bracket, you might be able to take a Roth conversion and stay in the tax bracket, or maybe just get into the next one, so that you can massage these numbers to end up with a positive result. And it's not all or nothing. You can do a Roth conversion this year and then do another one next year on a different account. It could be partial or whole.
And
But if I go through and I do second discussion, I'm 85 years old, I'm in lousy health. Should I do a Roth conversion, or is there a 5-year limitation?
Well, the two things. One is that, first of all, that's one of the factors we want to think about. If you're in bad health, and does this make sense? Are you going to have a time horizon that makes sense? But then there are also other rules, and I think you're referring to the seasoning rules, the 5-year rules, before you can start withdrawing the income on this. So we have to take each case by case. I do want to point out, and I think you've done this before, Pete, is that you can always get your principal back.
Yes.
It's just the tax-free growth that is subject to tax.
Yeah, and remember that's completely different than a regular IRA. So if you can withdraw your principal at any time and not be subject to any kind of penalties. But if you know exactly when you're going to die, Don, to makes the estate planning objectives a lot easier. So you do need to look realistically at your life expectancy when you do these Roth IRA conversions, whether it's for yourself or maybe for your children. And that might be a good conversation started. We have Thanksgiving coming up, and you may want to start it off with, the turkey is dead. So let's talk a little bit about our IRA accounts and see how we want to pass those on.
Right. And
before the apple pie, by the way.
That's right. I have a point on here. There are also going to be some estate tax and estate planning objectives that can be achieved with a Roth IRA conversion. And as Peter said, this is something that a lot of careful analysis needs to be done before you pull the trigger on this.
Yes.
Now, the last slide that I want to talk about in my presentation is the potential of maybe jumpstarting a child or a grandchild's retirement fund by using a Roth account. And what I mean by that is that 100% of your child's earnings up to $6,000, and I say child or grandchild, can be put into a Roth account. So if a child works delivering pizzas or something like that and has earned income of $6,000, that child or grandchild doesn't have to put their own money into the Roth IRA. You can gift it into a Roth IRA for them. And this creates a really interesting way to save money. If the child's over 59 and a half, all of that money and all of the growth will be tax-free. If you're under 59 and a half, there's no taxes or penalties until all of the contributions are withdrawn. And even before age 59 and a half, there are special breaks for college and for first-time home purchases. But keep in mind that if we do this and we start making contributions for children and grandchildren, when they turn age 18, they do get control of these accounts, and want to make sure that they understand that they're not to withdraw the money, and that we want to keep it for their future retirement, which can really create an amazing tax-free nest egg. I'm not sure $5 billion like our PayPal person, but a lot of money.
Yeah, it's wonderful. And by the way, we as human beings don't learn a lot from gifts, and we treat money that is gifted to us a little different than monies that we have earned. And so make sure if you have a grandchild, reinforce the idea that this is money that they have earned, and it makes it a little bit more valuable to them, and it makes a little bit difference as to when they turn 18 as to how they spend that money.
Agreed. Now, today we've really focused on only one component of the of a estate plan, that's
I-
retirement account.
Michael, I want to keep you on your one main topic at the moment, various IRAs and IRDs and all the other alphabets we do. So the question is, I'm 72 years old and still working. I'm continuing to contribute to my 403B. And I plan to retire in October of next year. When do I have to start taking my RMD from that account? 22, 23?
So the way that I'm gonna, again, I'm the estate planning
You're a lawyer.
attorney.
It depends.
And no, I was gonna say, I'm the estate planning attorney, not the CPA. So this is a better question for the accountant. But the way I understand it is that in this year that you're continuing to work, that you will not have to do an RMD, but after you retire, your RMDs would start.
Yeah, and the RMD, if it depends on your 403B, that your 403B, if you're still working for that organization, you don't have to withdraw. If you have an IRA, though, take a look at it. But I agree with Michael. Check with your CPA.
And that raises one other question, which I think is a fascinating one. I'm getting confused. How many professionals do I need? An estate planner, a
Yes.
financial planner?
Yes.
What else? Why
A
can't I find
CPA.
someone who can do it all? And the answer
No.
is the CPA.
It's all complicated. If you have money, if that's kind of like saying, hey, I'm hired a general contractor. Why can't they do the electrical? Why can't they do the plumbing? Why can't they do the roof? It takes the specialties in each area to get you the correct position, which also is important why they need to communicate with one another.
Yeah, and the team, we call it, it really does have to be at least 3 people: the financial advisor, the CPA, and the attorney. And the team approach works well, especially with open communication.
And if somebody says to you that you can do it all with one individual, I would double
Wrong
check.
individual.
Yeah, I would double check. You just can't become an expert doing a multitude of disciplines.
Great.
Well, Michael, I've annoyed you throughout the entire session. Therefore, we have no questions really left. So we've covered that. I appreciate the fact that your contact information's up. I know that the last couple of slides you had were putting together the pieces of an estate plan and all the different areas, because there's an awful, as we've been saying just now, there's an awful lot to this, and it's not a simple yes or no answer in many cases. And every attorney I know and most of the CPAs I know, their favorite term is "it depends." And the older I get, the more interesting that is to me, I guess. But anyway, so we are at basically 11:30. So Michael, I thank you very much. This has been week 6 of It's Your Estate, talking about retirement accounts. Last one we were talking about, retirements and retirement accounts. And as we say, it's an interesting subject and there's a lot of pieces to it. So,
yeah, so if you have a significant, by the way, when someone dies, let's say for what is a significant amount in an IRA account? It depends. I mean, for some people, 300,000 is a significant amount. And what happens when a beneficiary pulls the money out and it's $300,000 and puts it in their own account, cashes it out? What
they
happens?
can't put it in their own account.
Huh? No, let's say you die in September and or November, and they pull it out in December out of your account and they put it in their own account, not an IRA account.
Thank you.
In their own checking account.
Thank you. That's what I thought. Yeah.
So $300,000, what would happen?
Well, they don't normally figure out the tax liability until April. And of course, all of that income is on their tax return, perhaps at a very, very high rate.
So when they do the tax return, that $300,000 plus whatever they regularly earn, that's the income tax bracket they're going to be in.
That's right.
And Medicare if they're over 65. Yes.
Wow. See, so even this 300,000 might be a significant amount.
And I want to come back to that because there was another question, and I'm sorry I didn't answer it before. we talk about what the threshold is in terms of going to probate. And the answer is $166,000. But if I have an IRA account, Pete's $300,000 account with a designated beneficiary, and that's outside of my trust, is that okay? Because it passes directly without probate.
That's right.
Okay.
Yeah.
So the 166, if you have a designated beneficiary, is excluded from the 166. So that's okay to have outside of your trust.
Yes.
Okay, excellent.
Do you generally recommend paid on death is a beneficiary designation, Michael? Insurance contracts are beneficiary designations. Should your attorney look at all of these?
Definitely. So as I mentioned, we like to take sort of a holistic approach. And so we want to look at our client's insurance situation as well as their retirement accounts and review their designations to make sure that it's all in proper order.
Yeah, there's a good question, and which we'll end up on. Don, do you want to take a look at it?
No, you go ahead. Go ahead.
Should we check with our adult children regarding some state and federal tax when planning our estate plan?
Yeah, so I think that's a really important point because having this conversation with the children, having them understand the tax consequences is likely going to get a better result and not have them do the mistaken lump sum distribution in the first year after you pass.
Right. Okay.
And
we're at 11:30, so I'm going to stop the recording.